Good morning, good afternoon, good evening, and welcome to the TGI. Thank God it's Friday, the 4th of November. Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. Going to go through our usual regular run through in here today. Look at the calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires to check out the fundamentals, the macroeconomic events that are impacting markets right here, right now. And we will also take a look at some charts and some trigger points. Right. Okay, let's take a look at the calendar first of all. We'll look back what we had this morning. PMI data out of Europe, better than expected in most cases. So there's a positive certainly coming through there. And then going into today, clearly the critical. Actually, we do have Bank of England member Pill speaking shortly, 43 minutes. Potentially gives us some colour on what's going on at the Bank of England. Obviously, you had that rate hike, 75 basis points rate hike yesterday. A lot of talk around them removing the bond buying program they've got at the moment. So we'll definitely be listening to that from the UK side. Whether it has effect on wider markets, US markets, broader markets, probably not. If we take a look in an hour's time, we get the employment report. Obviously, all eyes on that now for the US markets. And we're expecting the payroll data come in around the 200,000 mark. Yeah, there is 200,000 mark. What else do we have? That's kind of it. Rosengreen is actually speaking from the Fed later as well. That's scheduled for 10 o'clock Eastern time. But all eyes really on the employment report. Overnight, though, the big moves in here. So whether I'm not sure if they picked up on here. Yeah, so China hopes down here. So Twitter really not impacting us. Okay. Tech austerity, Amazon said. I've seen an Apple talking about hiring freezes, job cuts. The big thing that's impacted markets this morning has been China. And here, actually, that's not it. This is talking about, penalised airlines for bringing virus cases in the country, according to people from Minimata. Asana Fraser looking for ways to ease the impact of the COVID zero policy. So lots of talk about moving away from the COVID zero policy over the last week in here. Kind of sort of denied a couple of, initially sparked a big rally in Chinese stocks at the beginning of the week. Then we saw some kind of denial through the middle of the week. And now kind of that has been set on fire again. The prospect of the world's second biggest economy opening up, however speculative, fueled a frenzy in Chinese stocks after nearly 2 years of disappointment and $6 trillion of losses. And there's loads of headlines. I'll share the headlines on that. So that has helped stock futures back higher in here, and the US, European equity indices are higher, both boosted by those PMI data that we've had, all in the green. So the PMI data, obviously Purchasing Managers Index, looking up and down the supply chain. And certainly that's come through all very positive. So it's showing that the economies are weathering the storm in here at the moment. If we take a look ahead then, so look, stocks parity weekly losses on China reopening rally, speculation of China easing COVID policy boost sentiment. And then the futures right ahead of key jobs report. So all the focus on the jobs report in here going today. But there's loads of headlines that China's stock frenzy enters overdrive on hopes to worse over. Hang Seng Enterprise Index jumps 9% this week. Okay. What else do we have? Oil higher with commodities on optimism about China COVID easing again in here. What else do we have? Global food prices hold at 9-month low. Okay, that's interesting. So these are global food prices, so not necessarily impacting any particular economy, but nevertheless, it does show that some of the upward pressures, crop trade from Ukraine remains a vital element ahead, but it does show that some of those upward pressures on food prices that we've been seeing over the last 6 months or so in here, since the war in Ukraine, are easing a little bit. And interesting, Bank of America, this saw rush to cash is now at fastest pace since pandemic. Okay, cash funds saw 195 billion inflows so far in the fourth quarter. That's interesting. I'm not sure if this comes from their strategist. I'm not sure if this comes from the latest. I don't think. Oh, it is. It's Michael Hartnett speaking. So I guess it is. Whether he's talking about the fund managers survey. So I know Michael, good guy. Whether they're talking about the latest fund manager survey or whether that's just extra data they've got coming in. But nevertheless, we've been saying this, it's a good country indicator. Cash, the cash funds are massively underweight. Cash funds are massively overweight in here at the moment. And again, lots of articles on this. China stocks notch $1 trillion gain on hopes of reopening. better US ties, stock rally and oil rally, reports of China COVID respite. And then again, so it's all been about China this morning, looking back and looking forward about the jobs numbers. US jobs growth seen smallest in nearly 2 years. And the unemployment rate expected to rise. So we said 200,000. Unemployment rate expected to tick up to 3.6% from 3.5%. What else do we have in here? Yeah, we've looked at all of these. Morning bid labouring market gets China flip. So labouring market, obviously looking at the labour report, and then gets a Chinese flip in here from that boost. European shares rise as China reopening hopes lift luxury and mining stocks. So all the same stuff in here. And if we look at the European exchanges, we're up between 1% and 2% in here today. DAX German index nearly 1.6, French index over 2%, and the FTSE is up 1.25 in here this morning. And we've got a boost in here, obviously, with US futures following European counterparts and Asian markets higher, up about 0.8 in here across the board. The Dow up about 0.65 this morning, and that's after significant losses, particularly for the Nasdaq again yesterday. We spoke yesterday on the call about taking out those important impulse support points. Markets did continue lower, but then we did get a turnaround rebound. If you look at my reports in here today, go to the members area where the reports are uploaded. I've hung on to a bullish outlook. And the reason I hung on to the bullish outlook is at the close yesterday, most of the indices, not so much the Nasdaq, certainly the S&P, certainly the Dow, and then a lot of the others, and the gold as well. Gold had a big sell-off and then a strong intraday rebound. And so what we ended up on the daily charts is, and we'll look at them on the daily charts, they don't show so well, because then in after hours we got a dip lower. But at the closes last night, most of the charts were showing, obviously you got the after hours trading, so you got further trading, so the markets dipped back lower then. But at the close last night, most of the major indices, and gold as well, oil as well, most markets have sold off and rebounded. And they've all posted on the daily charts hammer candlesticks. And hammer candlesticks are strong positive reversal signals. Okay, so we've had obviously 2-3 down days in here, significant down days as well. We've got those hammer patterns yesterday going into obviously a big event today, going into the employment report. So that said to me, even though there was a lot of damage done yesterday, even though for the kind of slightly bigger picture view was very damaging, the supports that we took out on, particularly on the equity indices, gold made a new low. So gold's definitely looking very negative. Made a new low on the year yesterday, just poked to a new low. But then with those intraday rebounds producing daily candlesticks, daily hammer candlesticks in here, certainly said to me that there's risk back to the upside. I know I'm kind of clinging to that view, and it is kind of clinging to that view, and I kind of still cling to that view with the follow through that we're seeing this morning on the back of the China news. Okay, and that's obviously going into the data today. Okay, let's go take a look. So this one's not showing it so well in here. So that's not really a hammer, but on the close we were more up here, right? We were higher up on the close, so it was more of a hammer pattern. It's not showing that because then in the after hours, if we go to look at like the 15-minute chart. So in here, where's the close? So there's the sell-off into the on the open, and then post open we get the rebound in here. The market holds in, and then as we go to the close, the market's kind of holding in, and then we got an after. There's the close, and then the market sells off post close. Okay, so at the close we're up here. Okay, and then you get the late sell-off in here, which then makes that candlestick look more negative. When we were up here, you can imagine the candlestick back on the daily chart was more of a hammer. So the close was up here. Yeah, so this was more of a bullish candlestick in here, hammer candlestick. You look at it now and it doesn't look as positive, okay, because we got the post-closed sell-off down to here. And then the markets, obviously pushed all the way back higher, gradually through Asian hours with the Chinese news, and then through the European with that data from Europe as well. Okay, so all of this, we're taking out the peaks in here. So that's a positive as well. And I think if we can get up here to these peaks, then this looks super positive. We have had a dip back low in the last 30 minutes. I'm clinging to a positive day, but clearly it's going to be all about the employment report. If you get back down through this trend line, works really well. Back down through that trend line, that's coming in around the 37-36 area, down through there, looks negative. And then just below that, you got this swing low there. 37, 31 and 3/4. So 36 and 31 and 3/4 on the downside. Above the current peak looks even more positive, obviously. That is up at 66 1/4. But then you've got this impulse peak up here at 76, and then the high there, that swing high up there, is going to be the really important one at 82.5. Let's go take a look at the NASDAQ. So less positive on the NASDAQ. Again, the NASDAQ did, if we go to the 15-minute, so in here, so you get the sell-off and the rebound after the open. The market then closes here. Okay, this is the close, and then we sold off right on the close, so post-close, and then that damages that candlestick. So the candlestick wasn't looking, that looks a really negative candlestick. We closed right on the low, and we did also just nudge down at these supports in here this morning. But it's kind of just about holding there. That low there, 10,713. Last night we got to 708, so we just nudged it last night, and a little bit lower even this morning through 700, so 69275, and then the rebound. The NASDAQ definitely looks a lot more damaged and a lot more negative. If you look at this relative to the S&P, if we just look at the fib, right, what we've given up of the recovery rally from mid-October, we've just gone through the 50% on the S&P, right? Only just nudged at the 50% yesterday. If we go take a look at the NASDAQ, and look at the same rally, I'm just going to just make this a bit bigger. You can see you've pretty much given up most of it, right? And if I go and put the fib on, just so we can actually put some numbers on it, you're down through not only the 61.8% in here, but if I go and put on the $78.6, you're through the 78.6%. So you've given back all the major retracements. Okay, so you're down about 85% of the whole rally has been given up by the NASDAQ. So yeah, far more damaged and far more negative. But we go in here, yeah, and you have had this decent rally. We've taken out some resistance in here, little resistance from yesterday, 817.5, higher highs and higher lows. Again, you've got the trend line in here. So I'm clinging to a bullish theme in here. Got the trend line comes up through here. Down through the trend line, currently sitting around 770 is negative. Down through that overnight low, even more negative. That's just below 750. So we've got like 770 and 750 on the downside above the current peak. And then you've got these other peaks. So the current peak is 844.25, and then above there we've got 861.75, and then this peak up here, 888.5, 888.5. Yeah, but I think even above this one in here, the lower one gives you a bullish signal, 861.75 on the top side. So yeah, I mean, clinging to a bullish tone, but clinging. I'm not precious about that. If this starts taking out these supports, boom, you could have another 1.5-2% down day easy. For me, I think the risk is to the top side, but it's all going to be about the employment report. So we're just reacting to the employment report, really. But those are my trigger points anyway. And if we look at gold, as I say, gold made a new low yesterday. So gold, we just nudged below this low from September back in the end of October, and then we just nudged it below again. But then there's a better example of the hammer pattern. So most at the closes, the S&P was looking more like this hammer pattern, and you see gold's really boosted off of that boom. And looks, quite positive there, despite the damage done. As I say, it made a new low for the year, right? It made a new low for the year. But nevertheless, my report, you see, I'm saying positive, even though it made a new low because of that intraday turnaround. And if we look at the intraday turnaround, there it is there. There's the sell-off and there's the rebound, okay? So that produces the hammer pattern, and then boom, this morning up here, okay? And if we look at what it's given up on the sell-off, given that we just made a new low on this sell-off in here, but if we look at the sell-off from here through here, if we go take a look at what it's got back, it's got back on the fib from the high. You're now through the 61.8. So it's a really strong job been done by gold in here. So gold certainly pointing higher, although it's had a really good day already. My only reservation about gold in here, if I put on the, where are we? Don't you look at the indicator here very 80 up. Average true range. It's a 14 period. That works for me. So here's the 14 period average true range. So it's oscillating around $26 to $28 at the moment. Okay, so we move about $26 to $28. Today's high low is from the close yesterday. High low is 31 through 50. So we're at $26 already. That's my concern, right? That's my concern. Is if you look at the ranges in here, we only get every now and then we get a day like, say that day there, high low is 44 bucks. Okay. So has it got more in it? Potentially, yes. Has it got another 20 bucks in it? Maybe. Has it got 30 bucks in it? No, but you might get another 10 bucks on the top side on this. So yeah, I mean, there is potential, but it is stretched already. But it could get up into here to 16, 62, 63, somewhere up into this area here. Let's go look at oil. Oil's been more resilient. We said that yesterday. We did get the sell-off. We did get a dip and a rebound yesterday on the daily. It's not really, again, it's not showing after our sell-off, but massive rally on that China news in here today and here with the China reopening. And if we look at this, we've got this kind of tentative, it's kind of not really an inverse head and shoulders, but you kind of got it in here, like shoulder here, right? I'll just quickly draw these on. Art has not been my best subject. Let's see how we go though. Oops. Oh, that's not looking good at all. So you got kind of there, and then so you got shoulders here and here, and then you've got like the head here, right? You got the inverse head and shoulders there. So the neckline, you would argue, is kind of upward slope into it there, but you could argue there's a neckline through here. So you got these kind of tentative necklines. You could draw them off of various places, but I'm going to just draw a few on in here. We'll see, clearly there's more of a horizontal one coming across. Bear with me. Clearly there's more of almost a horizontal one there. You've already taken this one out this morning. Right? And then you've got like a whole line that's not the best trend line in here. This one across from here. Taken that out as well, so that's not the best line. I think the most important one is the one we've taken out this morning, and if so it could easily be back up to the peak in here, and then it's challenging this maybe going forward. But again, if we put on the ATR in here, right? If I put on the ATR, average true range, gives us the average range looking back 14 days. If I look at the ATR down here, it's telling me the ATR's around, it's been falling something like around $3, right? So in here, even if it gets up to like 380 kind of stuff, what have we done today? High low today is over $3, right? And it's telling me something about, and even when its peak is like 460 over here, when it's more volatile. So we're coming to what I like to call capacity limits. The market's almost moved as much as it wants to move. You can get these bigger days, so a really big day like that one there. I mean, you can get these massive days like this one here, but a big day like this one here, the market moves. High low there is $6, right? And today we've already done, what did I say? Today we've done 340, like $3.5, $4, okay, on the range. So you're kind of running out of capacity, okay. But it could get back up to the high. Wouldn't be surprised if it does challenge the high. Again, it's going to need a risk-on move, right? It's going to need a positive move from stocks and a positive outcome from payroll. And what do we want from payroll? There's the question, right? At the moment, good news is bad news. You don't want this too strong. What we really want is we want it to be probably a little bit higher than the 200, but not too much. If it's 300, then it opens the door for the Fed to say, hike more aggressively, and the market probably sells off, perversely, counterintuitively. A too bullish number is probably going to be bad for stocks. You don't want it too bullish, but you don't want it this collapsing either. We don't want us telling us we're going into recession. You don't want it at 100. What you want it is around this number, or slightly better probably. So you probably want it around 230, 220, 230. Above expectations means the economy is still, the labor market's still strong. It keeps the consumer strong. It means we're potentially going to avoid or have a mild recession, but it doesn't give the Fed the ammunition to be even more hawkish. So you want a positive but not too positive number. A too positive number, too much good news at the moment, you can be viewed, too much positive news from the consumer, from the labor market can be seen, has often been reacted to in a negative way. So you got that counterintuitive move, a negative way from the stock indices. All right, everyone, I'm going to wrap it up there. I'm going to wish you all a great trading day. Helmets and goggles on for the employment report. I will be back with you on Monday. Have a great weekend too, and stay safe. Take care.